another time.
It's for next
week. So we'll get into those programs next week. We'll get into conventional programs next week. Okay.
Okay. So MIP
is
only for FHA.
Is FHA.
Okay.
Yeah, mortgage insurance premium.
Right.
Versus private mortgage.
So that's what we're doing. Yep. We are currently.
Okay. And one thing I will really say about this program really applies to all of them is that every situation is going to be different. I can't give you a sheet of paper here that's going to allow you to determine what your borrowers qualify or if they qualify. Okay? All I'm going to do is give you bullet points so you understand who fits in the basic parameters of FHA loans. Okay? Once again, that is going to be my job to make sure that they qualify. Okay? Because there could be something you just don't think about. Okay? Foreclosures, bankruptcies, even though they may have the credit score necessary, but maybe they had a bankruptcy 2 years ago. FHA, that's not allowed anymore. It used to be 2 years, now it's 3. Those things are constantly moving. They're very fluid right now, okay? So I would just say, let me look at it and let me qualify them for you, okay? But at least this gives you the nuts and bolts of FHA loans, okay?
That's a good question. I sold a house and she got an FHA loan that's assumable.
Okay.
And so now she's getting ready to list it. Is that a positive for?
I would say in this market right now,
Probably
no.
not.
Because assumable mortgages can turn into nightmares down the road. Okay. Number one, and this goes back to what I talked about earlier, if you have an FHA loan and you have somebody assume it, you cannot get new FHA financing. It's got to be conventional, because that would be considered 2 FHA loans out. Okay. Secondly, 10 years down the line, if you're trying to co-sign for your kids and get them an FHA loan, but that FHA loan went bad or was never paid off, you can't get financing. Okay? So know that you've got assumable mortgages. While maybe if rates go to 10%, they might become attractive. There's a lot of risk involved in having an assumable mortgage because you're still going to be liable.
Really big deal, didn't
right.
it, years ago? Okay.
Right. Okay.
How about on FHA? Is there still the ability to get gift money from a family member?
Yeah. The gift, and also in certain situations, if we can prove to an underwriter the relationship, the gift can also be from non-relatives.
Oh.
Okay, so keep that in mind. It's at the underwriter's discretion. Okay, but let's say a longtime friend. Okay, maybe a roommate. Those kind of things. If we can prove the relationship on paper, it doesn't necessarily have to. It's not written in stone. It has to be a relative.
Is that how new is that?
That's very new.
That's very new because I've never heard of that.
Yep. Okay. Next program, VA program. The VA is obviously for veterans. Okay. A couple of things about the VA loans. The maximum loan amount is $417,000. Okay. What we've got to do on a VA loan, the first thing we do is we go ahead and obtain a certificate of eligibility. Okay. This used to be a tireless process. It took forever through the VA. Now it's simply going to a website and requesting information. You can get it almost instantaneously. Okay. So what I do is I get the certificate of eligibility, and that eligibility will either be fully entitled or there'll be hits against it. Okay. If there's hits against it, then we've got to go ahead and try to restore all the eligibility for the veteran, or he's limited on what he can buy. Okay.
When you say hits against it, what is
a hit against the certificate of eligibility could be maybe you've got a VA loan that wasn't shown as paid off, maybe 10 years ago. Those kind of things. We've got to go ahead and get that eligibility restored. Okay, because you use up your eligibility when you buy a VA loan, but then when you sell it off, it's restored. Okay, so what we'd like to see when we get a certificate of eligibility is a fully entitled certificate of eligibility. Okay?
But a veteran can have more than one VA loan.
Yes, just the entitlement is going to be less on the second.
Right.
And when that's, we'll just have to see that form and see how much they have left. Okay, so once again, that's what you will need to do if you're dealing with a veteran is get his discharge paperwork. Okay, something with his service number on it, and then I will pull the certificate of eligibility for you.
Isn't it like a T406T or
DD 214?
DD 214
is the form.
812.
Yep.
Okay.
DD 214 is the discharge form that we need. Okay, and the veteran will know exactly
214.
DD 214. I just call it as discharge paperwork instead of using the official VA number. And the veteran will know exactly what you're talking about.
But if you say DD 214 to a vet, they might be impressed.
Yes.
So is a vet only someone that's retired from the military?
Say that again?
Is a vet someone that's only retired? From
No,
the
that's a
military?
great question too.
They
It
can be
is
still
for
be
active.
in.
It is absolutely for active duty military as well.
So why discharge paper if they're still active?
Well, and once again, the discharge paperwork is for 9 out of every 10 I deal with are retired, discharged from the military.
Okay.
If they're not, then I just get their service letter.
Okay.
And
they're
a service
active.
letter is basically a letter from their commanding officer that states their position. Okay, it also has their service number.
Okay.
Okay, and I can obtain their certificate of eligibility through that.
Okay.
Okay. The main benefit of a VA loan is there is absolutely no down payment required on a VA transaction. Okay, that's one of the true remaining 100% programs out there. Okay,
What about USDA?
that is the other one.
Oh,
There you go. We're not covering that today, though. That wasn't on the agenda. Okay, so no down payment, closing costs up to 6% paid by seller. So once again, this truly is one of those programs they can get in with absolutely nothing down. Okay.
Actually, they.
I mean, Tori
Must they
and
want
I just closed a VA transaction a couple weeks ago, and the borrower had put $500 down as an earnest deposit. He got a check back at closing for $500. Okay, so absolutely no money down in those particular programs if you have the seller contribute the appropriate amount.
I was to say the only reason he got that earnest
Right.
deposit back is because he utilized the up to 6% of the loan amount can be paid by the seller
Right.
for closing costs. So you went in on the contract, the finance addendum, and said, "I want you to pay up to 6%." If it was a $100,000 purchase, you put $6,000 in the financing addendum.
It's close to that.
Okay,
It was enough to get it done.
yeah,
It was enough to
and
get it done.
that should be enough to get it done.
Right. And understand, when we say closing costs, we're referring to all settlement charges in the transaction. So your first year's homeowner's insurance, your tax escrow, your insurance escrow, your interest, and all closing costs. Okay? So it's everything with the transaction.
So closing costs and
And prepaid, yes.
And we usually always get that paid by the seller anyway.
You know, I would say 8 out of every 10 transactions, I see the seller contributing something towards closing
Yes.
costs.
Yeah, we always try to ask for it because we're representing the buyer. VA, FHA or not, we always try to get the seller to pay for a little
Especially,
bit.
right, especially in low down payment programs, because obviously those people, their one struggle is cash for the transaction. Okay? Minimum credit score is 640, just like FHA. Okay? An important thing also remember on VA is that you do not, with FHA you pay that monthly mortgage insurance, which is expensive. VA, you do not pay that. You do not pay a monthly mortgage insurance premium for VA loans. Okay? What you pay for VA is a one-time funding fee. Okay? The funding fee is financed into the loan. So in other words, if you buy a home for $100,000, you have no down payment. Your loan is $100,000 plus the VA funding fee. Now let's say down at the bottom there's a VA funding fee chart. Let's say if it's an active duty or retired, and the funding fee is 2.15%. So on a $100,000 purchase, his funding fee is $2,150. So his loan amount is $102,150. Okay? We simply add that funding fee to the loan amount. Okay? And come up with that number. Okay, there are other scenarios, and I put the entire chart down there, that you'll see that if the veteran does want to put more money down, the VA funding fee will decrease. Okay, he'll save money on the funding fee by putting more money down. Okay, for me, it's not a significant enough savings to go ahead and try to get the veteran borrower to go ahead and scrounge together money for a down payment. Okay, it really is not significant. That's significant of a difference.
Well, I mean, so what's in between a $100,000 loan and a $103,000 loan? I mean, per month
You're looking at a difference of maybe
$4.
dollars.
This is the
Yeah.
lowest payment though.
Well, he's going to have a lower.
$5.
He will have a lower payment, but not significantly.
Yeah.
Okay. Now, the one thing to understand about down payment, I mean, a lot of times we try to get more down payment to avoid higher mortgage insurance fees.
Absolutely.
And
But
with
VA
VA, really, yeah, it doesn't. There's not a whole lot of points to it. I mean, it doesn't matter to go ahead